Investing money might seem like an overwhelming challenge, especially when you're aiming for quick returns. But what if I told you that with the right knowledge and strategy, you can start seeing results sooner than you think? In this video, we're going to explore actionable strategies, the best investment options, and critical principles that will help you make informed decisions and maximize your chances of earning quick returns. Let's dive in and get you on the right track to achieving your financial goals. To kick things off, we need to define what investing really is. Essentially, investing means putting your money into opportunities that can generate a return or profit over time. Whether it's stocks, bonds, real estate, mutual funds, or cryptocurrencies, the possibilities are vast. However, getting a quick return requires a more calculated approach, and that's exactly what we're going to break down today. The key to achieving quick returns is understanding market timing and risk management. Many people get caught up in speculation risky bets that might deliver fast rewards, but are equally capable of leading to significant losses. So, while the prospect of big gains is tempting, it's crucial to make your decisions based on informed analysis and well-researched strategies. To begin, let's focus on the right investment types for those looking to earn quicker returns. You're after fast profits. Assets like growth stocks, high-yield bonds, crypto assets, or short-term funds should be at the top of your radar. These types of investments have higher potential for short-term gains, but also come with increased volatility. It's important to remember that the greater the potential reward, the greater the risk. As an investor, you must first identify your investment profile. Are you a conservative investor, prioritizing safety, or are you prepared to embrace volatility for higher returns? Knowing where you stand will determine the types of investments that are right for you. If you're more risk-averse, fixed income securities or government bonds might be your ideal fit. If you're comfortable taking on more risk, stocks or cryptocurrencies could help you capitalize on short-term fluctuations. Once you've chosen the right investment vehicle, the next step is learning how to minimize risks while positioning yourself for returns. Protecting your capital is key to ensuring that your investments grow safely and sustainably. Diversification is one of the most powerful strategies to safeguard your investments. When you diversify, you spread your money across various assets, which helps reduce the risk of a single poor-performing investment dragging down your entire portfolio. For example, if you put all your funds into one stock or cryptocurrency, you risk losing everything if that particular asset takes a dive. By diversifying into different stocks, bonds, cryptocurrencies, or even real estate, you're better equipped to handle market fluctuations. A well-diversified portfolio has a better chance of weathering the ups and downs of the market. So, instead of putting all your money into one investment, consider spreading it out. This way, if one sector underperforms, others may compensate and help stabilize your portfolio. When it comes to investing wisely, it's not just about choosing the right assets, it's about using the right tools to guide your decisions. Today, you don't need to be an expert to navigate the financial markets thanks to numerous resources available. Even beginner investors can start making more informed choices. Pay attention to market news and track financial trends using online tools like Yahoo Finance, TradingView, and Investing. These websites provide real-time market data, charts, and analysis that can give you insights into how different assets are performing. Technical analysis and fundamental analysis are both methods used by successful investors to evaluate an asset's potential. Even if you're just getting started, understanding the basics of both can help you make smarter, data-driven decisions. In addition to market research, regularly monitoring your investments is vital. Platforms like CoinMarketCap for cryptocurrencies and Binance for stocks can help you keep track of market movements. Armed with the right data, you'll be able to spot patterns, understand market shifts, and adjust your strategy accordingly. One crucial step in protecting your investments is rebalancing your portfolio. Over time, certain assets may outperform others, causing your original portfolio distribution to get out of alignment. For example, if stocks in your portfolio increase in value, they could account for a larger portion of your total portfolio than you intended. To maintain the right level of risk, it's important to periodically assess your portfolio and make adjustments when necessary. Rebalancing is like giving your investments a tuna ensuring they remain in line with your goals and risk tolerance. By periodically selling off high-performing assets and redistributing funds into other areas, you help maintain the right balance in your portfolio. Now that we've discussed investment types, tools, and risk management, let's talk about the most important part of this process: setting clear financial goals. Without goals, you might find yourself investing aimlessly, which can lead to impulsive decisions. So ask yourself, what are you trying to achieve? Do you want quick profits, or are you more interested in long-term growth? Defining your goals will help keep you focused and will guide you toward the most appropriate investments. For those seeking fast returns, focusing on higher risk, higher reward assets like growth stocks and cryptocurrency might make sense. On the other hand, if long-term wealth building is your goal, you might prefer stable, low-risk options like bonds or index funds. Defining your investment timeline and setting realistic goals will help you avoid taking unnecessary risks. As we move forward, let's focus on the mistakes that new investors often make. Avoiding these pitfalls is essential to your success in the investment world. One major mistake is over-concentration, putting all your money into one investment. This increases the risk of catastrophic losses. Diversification is essential to ensure that your portfolio can withstand the volatility of the market. Instead of betting it all on one asset, try to build a diversified portfolio that includes different asset classes. This will help protect you against sudden shifts in the market. Another mistake is impulsive decision-making. The financial markets can be highly volatile, and it's easy to get swept up in the excitement. However, making investment decisions on a whim can lead to disastrous outcomes. Always take the time to do your research and don't let short-term emotions dictate your actions. Additionally, transaction fees can eat away at your profits if you're not careful. Every time you buy or sell an asset, there might be fees involved, and over time, these can add up. Be mindful of platforms with high transaction fees and try to minimize the frequency of trades to avoid excessive costs. Most importantly, don't chase short-term profits at the expense of long-term strategy. While quick returns are tempting, the key to sustained success lies in maintaining a balanced, well-thought-out portfolio. Lastly, ensure you have an emergency fund. This separate savings account will give you the peace of mind to weather any financial storms without needing to touch your investments. With all of this in mind, the road to successful investing is clear. Make informed decisions, manage risk, and always stay focused on your long-term financial goals. While it's tempting to go after quick profits, a well-thought-out strategy will lead you to better results in the long run. Remember, investing isn't a one-time decision, it is a journey that requires continual learning and adaptation. With persistence, a diversified approach, and a willingness to adapt to changing market conditions, you can achieve the financial freedom you're aiming for.